This is the Phelan and Myers 2 for 20 with the Willett, Phelan, Myers and Rott's Wealth Management Group of Janney Montgomery Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130, Duluth, Georgia.
Good morning and welcome to Phelan and Myers 2 for 20. This is Scott Phelan. I'm here with Kevin Myers, and we are lucky enough to have Chris Marinac with us today. He is the Director of Research at Janney Montgomery Scott. Now, you might recognize the name because he's regularly on CNBC, Fox Business, Bloomberg. You've done them all, haven't you?
I have. It's been an adventure the last 2 years for sure.
No, so tell me a little bit about your background. Tell me where you've been, and
Sure.
Obviously the title Director of Research kind of explains itself, but can you put a little color on that?
So I've been a financial analyst covering the banking industry since 1992. I started out the original Interstate Johnson Lane, which is now part of the folklore from the old Wachovia Securities and now part of Wells Fargo. But I worked there for 5 years. Then I graduated to the Robinson Humphrey Company and worked there for a few years, and then it was acquired by SunTrust back in 2001. And I stayed there for 2 more years. And then in 2003, I began FIG Partners, which was really an adventure. Started a broker-dealer from scratch with a few friends. And FIG had a great run from 2003 to 2019. We were a market maker in over 700 bank stocks. We had a small investment bank doing advisory and capital raises for banks of all sizes, primarily community banks, but really we looked at the whole industry from top to bottom. And Janney acquired us in May of 2019. And so here we are. The rest is history.
Okay. So you're the Director of Research with kind of an emphasis on banking. Is that an accurate
Correct.
statement?
I'm still, I guess you call me a player coach.
Okay. Okay. So we're going to talk about a lot of different stuff today, but let's talk about start out anyway with what's really in the headlines, which are interest rates.
Yep.
You know, there's a lot of conversation about rates going to get cut. I think the Fed's pricing in, or the market's pricing in, that the Fed's going to cut rates in September. What's your opinion? What's the Janney position on it?
So my thought is that interest rates have had this 20-year run where they were at zero a couple of times, and that's not sustainable. If you go back 50 to 60 years, the Fed funds rate has averaged about 5%, and I think we're actually going to be closer to that 5% average than we are going to be far away. That doesn't mean that it's not going to go down or the Fed's not going to change policy. You know, the Fed decides what it wants to do. It's not like it's not Mother Nature deciding how much sunshine or rain we have. The Fed's going to decide if we want to go to zero, if we actually went negative. You know, there have been many countries around the globe who have done negative interest rates and it didn't work. The Fed, I think, is experimenting with this 5.33 Fed funds rate to see how long they can do it. And there are some structural issues in the country that really require us to pay higher interest rates, such as financing the debt. So I just don't buy the idea that the Fed's going to cut a lot. I think they could cut once or twice. Beyond that, it depends on what happens externally. You know, we may have a really good economy or an economy that doesn't go into recession, and that's going to drive the level of interest rates. We may not have success financing the deficit. That's going to drive interest rates. So a lot of those are at play. So the other thing I would remind everybody is the market's discounting certain rate cuts and certain rate increases over the course of time. The market gets it wrong all the time. It's taken me my whole 33-year career to kind of figure out the market doesn't always have it right. The market's not efficient, at least on topics like interest rates and economics. It's a constant discounting factor based on the information it has.
So you're thinking 1 or 2 total rate cuts, not just this year, total rate cuts.
I'm thinking a couple. Maybe I'll put 3. You know, we think of Fed funds at 5.33 going down to 4.50 by 2026. So it's a very limited haircut. I could be wrong on that, but I just don't think there's the rationale to go much below 3 or 450. I know the Fed is more political these days, so for politics purposes, we may see them act differently these next 3 months. But beyond that, I still have a hard time below 450.
Okay. And can you explain to our listeners, just real briefly, kind of how interest rates are set? You know, what does the market determine versus what does the Fed determine?
Sure. So, you know, you have the Treasury market, bills and notes and bonds that are trading 24/7 around the world. And the U.S., of course, is the biggest country and the biggest, public financing vehicle, and so that is the sort of staple that both institutional and individual investors globally invest in. We are the lead currency, we're the lead country, and the lead dog, and so that is kind of how rates are set from those treasuries. The Fed is trying to benchmark, excuse me, the short-term rate, which is the Fed funds rate. That's a policy rate that they dictate. And sure, the market will trade futures and options trying to predict the direction up or down of that, but it still is a Fed policy at 533. But what happens at the intermediate and longer end is all a function of supply and demand. And what's really happening around the world the last 15 years is we've gone from being a financing to a refinancing vehicle, because we're kind of refinancing the existing debt and rolling it over constantly, and not just in the U.S., but also in other countries. So, so the dynamic has changed the last 20 years. And so all of that supply is out there, and it does put pressure on interest rates. And so, while the Fed's trying to set the low end and be the anchor at the short-term policy rate, the market's really dictating what's happening. And then, of course, you go from the government end up to the corporate end, and obviously the corporate end is going to be driven by how well the credit is. You have a very good a company like a Home Depot or Coca-Cola that can finance at low spreads. You have much higher risk grades, a C or C minus or even a junk rating. They're going to finance at much wider spreads. And of course, those spreads will widen or tighten as given the attitude about the economy.
Okay. So let's gravitate toward lending here for just a second. So 2008, 2009, there were a lot of regulations put on banks in terms of how they're capitalized.
Sure.
And so you've seen a lot of alternate lending sources pop up out there. Can you kind of just give us a layman's explanation of what happened and then how the market gravitated away from bank lending?
Sure. So prior to 2008, most lending in the country was done by banks. There was a little bit of institutional lending done by pension funds and sort of state-related entities, but for the most part, the banks were the driving force. Because the banking system sort of fell on its back, and it was pretty ugly for a good 2 or 3 years, you had to rescue the banking industry with TARP, and save several institutions, and of course make a couple institutions like Goldman and Morgan Stanley into banks at the time in fall of 2008. That led to a lack of confidence in the banks actually being lenders, and the creation was, why can't Wall Street and other private entities create funds that can lend money? So we've seen this alternative credit, private credit evolve the last 16 years. It's really kind of culminated as COVID happened to put more dollars in alternative sources. Again, a byproduct of zero interest rates for a couple years there in 2020 and 21. So today you now have these vast pools of money, a lot of which have been funded by institutional investors globally, foreign governments and others who are backing that type of lending. There are a lot of folks who started and cut their teeth at banks and also at Wall Street firms who understand credit, and they've gravitated over to working for those private funds. And that's kind of today's private equity firms who have sponsored a lot of funds in addition to kind of what they're doing on PE. So the PE firms are buying companies, they're also lending money, they're starting alternative vehicles. We see some of that in the BDCs, business development companies, but you also have a bunch of private funds that are out there, and some big household names, and then a lot of names you never heard of.
Okay. And, back in it seemed like in the 70s and 80s, I've got a number of clients that bought a local, non-publicly traded community bank stock that got bought by a regional, that maybe got bought by a bigger regional, that got bought by a national bank. And then they just took the ride up, from that original purchase. You don't really see that a whole lot anymore. And I've been told that the reason for that is the state of Georgia's not issuing any more bank charters. You literally have to go buy an existing bank. Can you explain a little bit of that history?
Sure. So from 2006 to 2010, we had 200, maybe 250 banks fail in the country, a lot of which were in Georgia. The Georgia Department of Banking was probably a little bit too easy to give charters, so a lesson learned from that saga was to make it very difficult. But it also goes to FDIC. I mean, it's a national organization, the FDIC, and they set the policy for kind of how you grant bank charters for deposit insurance purposes. So you have a lot more capital necessary, a lot more stricter rules. You can't flip a bank in 3 years. You need to hold that bank many more years. So it just becomes more difficult. You basically could have raised $15, $20 million and have a community bank. Today, that number is going to be $60 million at the low end and probably more like 100 plus. You're also going to have a 7 7-year time frame instead of a 3-year time frame. So the whole return on equity just isn't as sexy as it is if you were trying to buy something that was an AI.
Okay.
You would get a much faster return, a faster pop. And so the appeal of investing in a bank is just not as attractive. There are still a few being done. There's one being formed as we speak in Miami. There's a couple that are new charters granted every year. There's been a couple fintech related stuff that has happened in terms of new charters, but it's very few and far between. If you want to take a bank and reposition it, that you can do. You take an existing charter, perhaps relocate it to a major area, add more capital. That is where the activity is today. It's not as much creating a new bank. So you still can do the private bank, but it's going to come from a different methodology. And you really saw that here locally, here in your part of Atlanta, with the bank that's, in your office building. Mm-hmm. They're an excellent example of that. And they're doing really well.
Yep. So let's take a look at the bigger picture here for a minute. In your opinion, where are we with the economy? What's the current state of the economy?
So the economy, from my standpoint as a bank analyst, is you have to think about the credit cycles, and we haven't had a credit cycle since the 2008 to 2010 or 08 to 11 time frame with the great financial crisis. We're kind of due to have one. We thought COVID was going to be that marker. It ended up not being because of all the government stimulus, and it ended up being a very benign credit issue. But it feels to us that the credit cycle is going to rear itself in 2005 or 25 and 26, and to a lesser extent 24. But it doesn't necessarily have to be anything cataclysmic. It could simply be a rainstorm or a snowfall that is moderate and not anything, dastardly, if I could use that word. I think that what we see is that if I had to put a baseball parlance, I'd say it's the 4th inning, and that we go 9 innings and we're going to have worse credit quality as we go along. But the fundamental difference for the banks is the banks are leveraging a lot less than they used to. So banks are lending at 60 to 65 cents on the original dollar, not the 95 to 100 cents on the dollar that they did in 2006 and 7. That led to big losses, particularly when you look at real estate and land and all of those things that were ugly back in the great financial crisis. Today, it's much more a loan that was done at 3.5% interest, and today's market is at 7.5%. And so that loan is underwater just because interest rates have gone up. And you may have a multifamily property that could be in New York City that has rent control, and you have concerns about the viability of that, but it's still leased really well. It really has interest rate risk. The biggest issue on some of those multifamily deals is interest rate risk. And then the other type of things that we have, obviously, are office properties, and we could talk all day about office. Office tends to be a bigger issue for the biggest banks and the biggest lenders, and some of those are not FDIC-insured U.S. banks. They would be foreign players. They would be funds that were created that actually are part of this private credit industry that you're asking about a minute ago. That's where the big office properties are. That's really where the risk is. If we look at a suburban office setting, you just have less demand for office space, but I don't think it's as much of a problem. In fact, I actually think the office space may have peaked in its angst, and we're actually starting to see some of it come back. But, there's been permanent changes to how people work, and so the need for office space is different. And we're going to continue to churn through that probably the next 5 years. But I don't think that's in itself a problem because of the concentration of office is not that big. It's more of a nuisance, if anything else.
So you think the economy may falter a little bit, or there might be issues in the economy, right, predominantly credit related.
Correct.
But it won't be similar to 08, 09, where there were a lot of banks that were teetering.
Correct.
Okay.
We think there are very few banks. The banks that have failed for interest rate risk. The 3 main ones that were in the headlines last year in 2023 were interest rate driven. One that failed in Philadelphia this year was still interest rate driven. They couldn't raise capital because of their interest rate risk, and they just kind of ran out of, but they also did some foolish things with how they operated. So, there's generally stupidity to go around in every bank that fails. It's not a uniform thing, but I do think that the level of issues today are vastly less than it was 16 years ago.
And it seems to me that bank stocks or financial related stocks are a better value relative to the overall market.
Sure.
If you look at just the price to earnings ratio and what bank stocks trade at relative to the overall market, Agreed?
Oh, absolutely. In fact, I may get the statistic a little bit wrong, but I'll be generally right. It's about 54, 55% relative PE to the S&P 500 today for the KRE, which is the S&P Regional Bank ETF or benchmark. That had been as low as 41 or 42% last year. It was 49 about a month and a half ago. So we've really had a step up. And historically, that's been about 65 to 70%. With every year, we kind of get lower and lower on that relative PE just because technology sectors and other parts of the market, of the equity market, are just so strong and valued so differently that banks and financials have been left behind. That's why those market multiples are so cheap. But having said that, there's still a fundamental business, and there's still a business that is actually making money today. And I'd argue that even if you go through a recession, most banks are going to be profitable. They just won't make as much money as they did. But it goes back to less leverage than we had 15, 16 years ago.
So what banks do you think are doing a particularly good job? If you had to name your top three.
Sure.
That you think do a good job?
So here in the Southeast, we're blessed to have a lot of good operators who have survived. So I would say Ameris Bancorp here in Atlanta, ticker ABCB, that is a buy rated at Janney. First Citizens, FCNCA is another good example. I think Synovus, SNV, also buy rated, is an excellent player. I think they've come a long way with some of the mistakes that Synovus had made. Ameris is a company that has doubled in size. They did a merger in 2019, and they effectively have run that really well. And what you find in these companies is that the leadership tends to have a vision for what they want to do to take market share from other banks. They tend to take the business from Bank of America, Wells Fargo, JP Morgan City, and they bring it over. They bring over talent, and the talent moves their book of business. No different than our business, Scott. You grab good books of business and good people and then let them fly. And that's what those three banks are very good at doing. Now, I can rattle off another 20 examples too, because there's more than just three, but those are ones that I think definitely resonate. And each of those companies have a lot of work to still be done. They're not finished. They're not perfect by any means, but they have, I think, a very good nucleus, and I expect them to stick around here for the next several years.
Okay. Kevin, anything you want to add?
Yeah, well, you had mentioned earlier that sometimes the market gets it wrong with interest rates. I guess, is there a scenario where you could see rates actually surprising and going higher?
Sure. We could have inflation come back. We could have an issue of refunding the debt. The deficit in the U.S. is horrific in terms of how it's growing at a leapfrog. And we have military conflicts around the globe right now, and there could be a third one that eventually creates itself in Asia. And if that happens, that's going to be more spending. And who knows what happens with the election? But either way, I think there's definitely a military buildup that could happen, or at least replace some of the spending or some of the armaments that have been shipped over to various parts of the country or world rather.
Yep. Any other parts of the market outside of financials that you find particularly attractive right now?
I look at the technology business for financial services, and I still think there is a payments evolution that is happening. There are some really good payment companies that are out there who, the Global Payments of the world and Visa, MasterCard, players like that who really do create a new way of doing transactions. Some of that will happen in the banking industry and some of it won't, but I think that the way that we revolutionize payments is continuing to evolve. It's interesting because I think that the regulatory agencies kind of have their arms around some of it and other parts they don't. There are still parts of the country that I think, or parts of the business that I think could evolve. I mean, just think of how you do DraftKings or any of the other sports betting. A lot of those dollars are not sitting in the FDIC system, but they might be. And as they come in, there's a dollar there somewhere for either a financial institution or a payments company that does that. And the Fed is going to increasingly get their arms around that. And I think there's a profit there. There also are some good low cost deposits as well. I've been fascinated by the fintech world and how it's been able to strip out costs, because some of the small and medium-sized banks can offer the same services that Bank of America can, and they can do it because of technology. And so it's really leveling the playing cost and the playing field, and it's making better returns for all these companies. And I think actually that's one of the reasons why the banking industry is so healthy today, is that we've got our costs materially less than we had 20 years ago.
Mm-hmm. I got you.
If I could, just one little final thought is everybody, I think, understands a little bit, or have probably heard about what caused some of the issues with the regional banks last year. How would interest rates, if they do go lower, like the market's predicting, how would that might alleviate some of the pressure?
Sure. So right now you still have a mark-to-market issue on bank securities that are government-issued securities, but they were purchased at a 2% rate and now a 5 or 6% world, and so they're underwater. If you have a drop of the 5-year, 10-year interest rates, and we've had a little bit of that here the last 2 months, if it continues, and the Fed obviously cuts policy too, it's going to drag down interest rates and help those bonds trade better, which ultimately is going to mean the mark-to-market losses are less. So it's not going to be a survival versus thriving issue. All those companies are surviving. They're just going to have less of a headwind than they have had the past year. We think that is a good byproduct. Now, a lot of those securities were eventually going to pay off at par anyways, and some of those are already turning. It just is going to happen a little faster if you have a drop of interest rates. The other point too, Kevin, is it's also going to lower the cost of funds for every bank. We think the cost of funds has peaked this quarter, but I also think if you have a drop of interest rates, it's going to accelerate that sort of improvement. So it'll just happen a little. You'll have a little more sunshine a little faster. And the cost of funds is really the bank's, key factor of production. They are lending money and they're bringing in those dollars and paying a rate for that. So if you can lower the rate, it's going to help their margins get stronger.
That was awesome. Thank you. We appreciate you being here very much.
No worries. Glad to do it.
The information provided here is taken from sources which we believe to be reliable, but the accuracy and completeness of such information is not guaranteed by us. This is not an offer to sell or a solicitation of an offer to buy any securities. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Employees of Janney Montgomery Scott LLC or its affiliates may at times release written or oral commentary, technical analysis, or trading strategies that differ from the opinions expressed here. Investing may involve market risk, including possible loss of principal. Janney Montgomery Scott LLC, its affiliates, and its employees are not in the business of providing tax, regulatory, accounting, or legal advice. Any tax-related statements are not intended for and cannot be used or relied upon by any such taxpayer for the purpose of avoiding tax penalties. Any such taxpayer should seek advice based on the taxpayer's particular circumstances from an independent tax advisor. For more information about Janney, please see Janney's Relationship Summary, Form CRS, on www.janney.com/CRS, which details all material facts about the scope and terms of our relationship with you and any potential conflicts of interest.